Like I feel like it's maybe too on the nose for the moment.
That was my reaction. It's scary.
Well, you haven't seen the trailer. If you see the trailer, you'll be like, this probably isn't a great thing to wish cast out into the world, right? That was my impression at least. So, but of course I'll go see
Bob's silent, completely silent, has not a single reaction.
Hey Bob,
cool.
How do you feel about civil wars? Good.
Yeah, not generally against
good?
them.
All right, let's change the topics.
Not a fan?
I was thinking this is going to be like a little more upbeat.
No, we're getting there.
We're start with Civil War, and then we get more upbeat.
So
the Fed is dumping money in the streets.
Wait, I want to give you a couple of. Meb Faber did 75 facts from 2023 at the Idea Farm. We can't do 75 of them, but there's some really good stuff out there. Out of nearly 10,300 mutual funds and ETFs in the United States, there are more than 5,900 where the listed portfolio managers own no shares in the fund they manage. Do you believe that?
Yeah,
you can believe that?
Yeah, of course.
Why don't we just close those and then we go from 10,300 to 5,900?
Like why get hung up in your own investment management? It's like
come on. Hung up.
No, don't get high on your own supply. That's how I was taught.
Actually, all those people are holding low-cost diversified ETF.
Laughing at the shareholders of their funds.
The shareholders paying 150, 200 basis points.
What else you got?
How about this one? The Nikkei 225 was flat from July 1990 through November 13th, 2023. So that's not all markets are meant to be bought and hold.
Stocks only go up, right?
U.S. stocks.
Not in Japan, only U.S. stocks. Here's a good one. Blackstone hit $1 trillion this year in assets under management. Did you think that would happen?
Yeah, I guess there's economies of scale. They're just sucking up. They'll take $1 from anybody. Right?
You must have thoughts about private credit.
Oh, I mean, the beautiful thing about private credit, I'm in a bit of a snarky mood this afternoon, is that it's totally uncorrelated to any other asset class, right?
Yes.
Until you
have to get some money out of it,
right? Until you want to get your money out of it, and everyone defaults, right? I mean, I think it's the problem with private credit is that they are misleading people who genuinely.
Wait, I want to ask you about this. The distinction. Is the problem with the product or is the problem with the marketing of the product or both?
I mean, the product is fine. The product's not that interesting, right? You can go buy an ETF at 50 basis points to get essentially the same economic exposure as private credit.
but that marks the market. Nobody wants that.
Right. And
people
I don't want to see the prices. That's the alpha.
People want to be lied to.
Well, but the real problem is the idea of saying that's uncorrelated. Go read some of these marketing materials.
That's a lie.
Uncorrelated.
Yeah, so that's the problem I have with it.
And that is garbage.
Yeah.
Right? Like, how can you possibly say that a credit cycle is uncorrelated? Or like the credit cycle is the economic cycle, right? It's a different point in the economic cycle, but it is the economic cycle. And then, I mean, the other big issue is that there's no track record on these things. So they're like, well, I'm going to show you something from, January 2010. It's never defaulted. We've had no defaults basically in this product. It's like, of course you've had no defaults.
Yeah, it's zero interest rates since January 2010 also.
And then if you talk to these folks, you say, why don't you just backfill it with, say bank lending through time? Because all you're doing is just replacing bank lending. They're like, oh, no. We are so much better at picking than banks.
Is that the alpha, selecting who to make loans to and the likelihood that they'll pay?
Not at trillions of dollars of scale.
No.
There's no alpha at trillions of dollars of scale.
Okay.
Just like one bank or another bank might be better at lending to this sector or that sector, but at the banking, we're talking. There's been more private lending, private credit lending over the last 10 years than there has been coming out of banks.
Is that true?
There's a bubble in my inbox. I'll just tell you that.
Wait, is that true? There's more private credit loans than bank loans?
Than bank loans over
in dollar terms or in transactions?
Yeah. There's a good Wall Street Journal article about it.
Wall Street Journal did this article, to your point, where they showed like the bubbles of like all of these companies, like KKR,
right.
It was just huge. I wanted to play this from Mr. Powell yesterday.
Have Josh play it through somewhere.
Oh, even better. Josh, play it.
Where am I playing it from?
Yeah.
You gotta give me the link.
I'll Slack it. It's in the Slack.
Recent edition.
Not in Slack. Bear with me, everybody.
That's fresh water, FYI. That looks better on camera than the
You're not poisoning me here with this?
I just like to go to the 2620 mark.
If I get a little loopy later, we'll know what's in here.
No, this is the good stuff.
It is the new New York, right?
This is an Infinity commercial. My bad.
I sent you the audio in TCAF. You can just click.
You sent it to me.
It's in the TCAF Slack. It's
All right,
just the-
26.
2620.
You don't need to fast forward what I sent.
Jones, Financial Times.
What a voice.
Yeah, I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that
That's
we are
right.
going to have a soft landing. Yeah, then when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now real wages are now positive, so that wages are now moving up more than inflation as inflation comes down, and so that might help improve the mood of people. But we see those public opinion surveys.
All right, enough of this.
The thing that we can
Bob, do you think that the gap between how the economy is doing and how people feel the economy is doing is going to shrink in 2024?
I think so. And the reason why that is that the economy's doing pretty well. We've gotten an injection here, basically a bunch of stimulation, right? From stock prices back up through highs, interest rates coming down, all that. That's all good. And that should keep things tight, which should keep wage growth pretty good at a time when, we're getting a bit of a moment of moderation of inflation, right? So what do people really care about in terms of the vibes? It's not that complicated. It's
prices.
do they have a job?
Rent,
Are they earning income?
healthcare prices.
And what's the price at the pump? That's what matters, right?
You think price at the pump trumps healthcare premiums, or
It's a way to be able to see what's going on in the day to day.
people complain about right now auto insurance more than more. First of all, gasoline prices are down like 90 days straight or something.
Right.
Nobody's complaining about that. Everyone right now is complaining about auto out of nowhere. That's like the topic.
I bought a bag of dog food yesterday. It was $85, and I'm pretty sure it used to be $55 or $60. And
Well, you love your
I don't,
dog, right?
I don't care that it's not going to be $86 next month. And I'm speaking for America here. I'm a voice of the people. I care that it's $85. All of that 30% increase, that happened. That's not going away.
That's not going away. And the question is, are people going to feel like they're catching up? Because what the problem is not – the problem obviously is that big gap, and then also feeling like they're falling further behind. And so the question is, can we get a switch here where real wages start to rise, right, where people feel like things are getting a little easier for them, right, in 24. And I think – that's where we're going to see it's going to feel a little easier. It's still going to you're just going to pick up the tomato and be like, it's $3. What the heck, right? But if their job's still there and oil prices are coming down and they can start to feel a little bit of relief, they'll feel a little bit better. But the level is still pretty out of whack, right? So the vibes are still weak, but getting a bit better.
Getting a bit better is what we're all about.
Let's get this shit started. In the words of the great Ronnie Mund.
Compound and friends.
What show, John? What show is it?
Episode 122.
122. What's up?
Today's show is brought to you by Crane Shares. Let's talk about the KFA Mount Lucas Managed Futures Index Strategy ETF. The ticker there is KMLM. This is sub-advised by Mount Lucas Management, who in 1988 established the first passive index to measure returns to risk-bearing in futures markets. This has the potential hedge on equity, bonds, and commodity risk. It consists of 22 liquid futures contracts traded on U.S. and foreign exchanges such as copper, corn, sugar, gasoline, soybean. Duncan, how you feeling about soybeans? You bullish or bearish?
I'm bullish.
Well, they're long, so that's consistent. That jives. All right. To learn more, visit kfafunds.com/KMLM.
Guys, we have returning champion with us today. Bob Elliott is the co-founder, CEO, and CIO of Unlimited Funds, an asset manager providing easier access to hedge fund strategies. Bob was previously the head of Ray Dalio's research team at Bridgewater. Anything going on with Ray Dalio lately?
Nothing.
Did you get a Christmas card from the Dalio family this year? Yes? No?
I think I lost.
We don't have to go there. It's enough about Ray Dalio. Let this man end his year in peace. We're starting with a very simple question. Yesterday, there was an absolute eruption on Wall Street, and that followed arguably 5 of the best weeks I've ever seen in the stock market. But it was almost like a crescendo of the war is over. We won. We won with veritably no casualties.
Mission accomplished, baby.
Like literally, the Fed itself was like, we're probably going to have to the economy up to get inflation down. Like they were telling us that.
And the economy said, oh yeah, watch this.
And the economy LOL'd. We added 200,000 jobs last month. We're adding an average of, I think, 300,000 jobs over the last 12 months. Inflation over the last 17 months has come down from an 8 handle to a 3 handle, about to cross into a 2 handle. And core inflation too. Both are coming down rapidly. And did we do it? Like, is it that simple? We did it.
Oh, I don't know about that. I mean, like, if you think
We did it.
cheers for the Fed, right? Everyone wants to cheers, right? Everyone.
No, we want
wants to
this.
cheers.
We
No,
landed the
we
plane.
want you to-
we
we want
landed the
you to
plane
tell us.
despite them.
But
I don't think they get. I don't want to give them the credit, but like,
well, first of all, the Fed needed to tighten. Monetary policy was way too easy. But look, a big part of what you see is that this is a lot of it's the resolution of the supply chain issues, right? And so, yeah, when used autos were surging and now they're falling,
That's not the Fed.
that the Fed has nothing to do with
the Fed. The Fed doesn't print semiconductors.
right? Or semiconductors or
Right,
oil,
okay.
right?
We got that part, but also rents have fallen, and that a big part of that is the availability of capital and money feeds into wages, rent. Those things are now moderating too. That's some of that.
That's
is
a
the
lot of
Fed.
supply side stuff too, right? The amount of creation of units basically in tertiary areas is about as extreme as it's been. Secondary cities, Sunbelt cities, areas that had been seen a lot of migration.
Yeah,
that there just weren't enough apartments.
there still aren't.
There still aren't enough apartments.
Well, the median asking rent posted the biggest decline in over 3 years. So rents are still dropping. That's true. They're still 22% higher than they were in November 2019. But they're 4% below the highs. And if this continues to moderate and even deflate, this certainly should help the vibes.
It should. How much do you pay in rent? How much do you pay at the gas pump? Those are the basic things. How much do you pay in the grocery store? But we're sort of at the maximum here. That's the thing I would say.
The maximum what?
The maximum disinflationary impulse. Like gas prices are not going to keep falling every day forever.
Yeah.
Right.
Okay.
Rents.
That's a good point.
You're not going to have millions of units of rental apartments coming onto the market.
The deceleration is going to decelerate.
That's right. Well, then I like to call it the negative impulse, right? The disinflationary impulse is gonna moderate, right? Used cars went up and then came down. They're not going to go to zero. New cars aren't going to go to zero, right? And so the issue is, if you look at how inflation is right now, which is say 3 to 4%, it's not that great, not that low, considering the fact we basically have max disinflationary impulses in the economy.
Oh, I see.
Right.
But it's going to lap higher prices throughout the course of 2024, and it will, at least in comparison with year-ago monthly numbers, continue to look better and better.
It'll look better, but the question from the Fed's perspective is durability, right? Everyone in the market is looking at here and saying, well, we're gonna print 2% in these reports, measured inflation, and everything's set. But the question is, does it stay at 2%? It's not a question of does it print at 2%.
Do you think the risk is that the bond market, credit markets get too easy, stock market runs up too much, and all of a sudden we're right back to seeing inflation in wages?
Well, look at what we've seen in the last 8 weeks with oil prices falling and the stock market going to new highs.
Yeah, those two could revert.
Those 2 points
Yeah.
have translated directly into increased retail sales during the holiday season.
Okay.
Right? So we saw a big print in retail sales today, which is indicative of the fact the consumer's in great shape. And if anything is feeling better. If the consumer's feeling better, they're spending more and keeping growth elevated. And so, Chairman Powell gets on the presser yesterday, says, well, we've had a moderation of growth. Yeah, it went from 5, which was which was very elevated in the third quarter, and not it wasn't really 5. It was measured at 5. To the most recent Atlanta Fed GDP now at 2.5, right? 2.5 in an economy that has productivity growth of about 1 and labor force growth of about 1, 2.5 is above potential growth.
It should be 2.
Right? It should be 2 or 1.5 even.
So it does not require stimulus.
Right. It's certainly not a place where you're like, you know what we should do? Cut 170.
Well, here's a hilarious dichotomy.
Right?
So,
Is not. This is not the economy.
It's not an emergency.
It's not an emergency to cut as if we're in the middle of a recession.
yesterday, Powell said our actions have moved our policy rate well into restrictive territory. Later on during the day, I saw a tweet from Lisa Abramowicz. U.S. financial conditions are the most accommodative they've been since the Fed started hiking rates last year, according to Bloomberg U.S. financial conditions. That's obviously not through no fault of their own. But what if we find ourselves in an environment in 2024 where the economy starts to overheat, where the S&P is up 20%, home prices are up another 10%, and they have to say, "Holy shit, we gotta tighten again." Is that possible that we see those conditions ease too quickly?
Well, the thing that's actually interesting is if you look at the market pricing on the short rate market, you're actually seeing a lot of people piling into expectations of them easing, but what you're seeing is actually the probability of hikes next year starting to rise in that short rate market. And so people are I think a lot of folks, the smart money is looking at this set of conditions and saying the odds that there's a hike next year are not 0. They're getting higher because of the way that they're behaving.
Bob, everyone was like very good about pointing out the lag effect of hikes and why aren't we seeing it show up and why aren't spreads blowing out and why isn't this and why isn't that? Why wouldn't it work in the same way? So the Fed now indicating that its next move is an easing. Michael's point, like what if the stock market runs up, blah, blah, blah. Shouldn't there be lag effects to cuts? We have no evidence that the stock market running up will bring back about inflation. We have the opposite experience. If you think about 2012, 2013, stocks were ripping higher, like 50 and 60% rally, and we didn't get any inflation.
Yeah, because remember that was the jobless recovery.
Right.
It was the asset man's recovery, the asset owner's recovery.
That's right.
But it was the jobless recovery. But we have the opposite right now. We have a unemployment's at 3.7%.
Yeah.
Right? We're adding, essentially
But my point is the stock market wouldn't be the thing that causes it. It's the employment market.
Yeah, absolutely.
Okay.
Which is that the nominal income today, like income growth for high spending cohorts, like under $150,000, is growing between 5 and 6% a year. That's up 2 to 3% relative to where we were in 2019. So just think about that. Like that's the structural gap in the economy, right? Is that we're seeing income growth.
Yeah,
that continues to meaningfully outpace what's appropriate for the Fed to meet.
People, so you do a bunch of CNBC now. You do a great job, by the way. But you hear people say like, "Oh, the Fed doesn't want to see the market do this." It's like, are you fucking kidding me? Like in 2022, we had a NASDAQ crash that didn't affect prices in the real economy. It didn't affect really labor in the aggregate. So why do we think the Fed's biggest concern is that the stock market has a party?
I don't think they care that much about the stock market.
I don't either. Okay, I don't either.
But the problem is not the stock market. The problem is the bond market for them.
Okay,
that's what's going to test their credibility. Because right now,
so if that gets too easy,
they said 3 cuts.
Yeah.
Right in 2024, which wouldn't be what my choice would be, but is reasonable. It's kind of like the tweaky cuts of mid-90s policy. But then you go look at the market. I was coming up here on the subway, and 170 basis points priced in to cuts in 2024. What's going to happen is the Fed is either going to lose credibility by massively easing and meeting the market, or they're going to piss off the bond market by doing nothing close to the 170 basis points priced into the cuts.
So the 2-year yield had a one-day change that was greater yesterday than anything outside of the March SVB saga.
How many basis points did the 2-year fall yesterday? 30?
Where is this?
It was
34, I think.
Major.
Yeah, it was a lot. So look, that's the last 10 years. Outside of March, it was the largest decline, and I think a lot of this is due to positioning. Urian Timmer, this was December 5th, so 9 days ago, he tweeted, "What will the Fed do next? No one knows for sure, but the higher for longer trade has been a crowded one. Per the commitment of traders data below, which could explain the 72 basis point reversal of the 2-year." So people were massively short the 2-year, expecting higher rates. And so that trade has obviously been unwound. Do you think that it's been overdone?
Well, it looks actually a lot like what happened in the SVB time, right? Where particularly levered money hedge funds in SVB were massively positioned higher for longer. There was essentially a negative inflation shock there, which created a sharp reversal, and all those funds had to cut their risk in, pretty fast, and that created. But remember, what happened there was that expectations of December 23 cuts or rates went to almost 350 basis points
In March.
Yeah. Right. And where are we today? We are not at 350 basis points. We're a whole heck of a long way from 350 basis points. Right. And we're seeing basically the same dynamic play out. The hedge funds were positioned higher for longer. They got caught on the wrong side of this. They're all being told to cut their risk.
Is that what's bringing about what we saw in the 2-year yesterday? It's hedge funds unwinding a trade.
Yeah.
And they no longer believe
the macro funds that was the position that they were holding.
Higher for longer.
That they were holding a position higher for longer. And the reason why they're holding a position higher for longer is not random.
No, the Fed said that.
The Fed said that.
Many times.
Unemployment's at secular lows. Income growth's still high.
Economy's strong.
The economy's strong. Like if you just took the normal look at what's going on, you'd say, is policy restrictive? Well, policy is not that restrictive, like relative to conditions. It doesn't seem particularly.
So what do you think about this theory that I'm baking in the oven, that mortgage rates are now down to 6.5%? So a combination of the housing market being reopened, maybe the IPO window opens up, maybe people feel a lot richer because their portfolios are higher, and consumer spending goes berserk, and they have to tighten it again.
Well, I mean, look, relative to 170 basis points priced in of easing over the next year, like the Fed could do nothing, and it would be a huge surprise. Right?
Isn't the offset
even the 3 cuts they said that they were going to do would be a huge surprise given the way the market's priced?
Isn't the offset how much debt has to be repriced this year? Wouldn't that maybe help keep things in check?
I mean, you can.
Or is it just not enough to matter?
It's not enough to matter. Like the terming out of the debt. I mean, this is the challenge: is that normal. If you go back whatever cycles decades ago, the short-term financing conditions really mattered. But now you look at things, and everyone will show you a nice curve of there's the wall, but look at the wall. The wall is so far away that it doesn't matter.
Okay.
The wall doesn't matter for the Fed. It doesn't matter for trading markets today. It doesn't matter.
So that won't keep the economy. If the economy's ready to run now, or if the stock market is ready to anticipate that the economy is about to run, and if the consumer is ready to start running,
the wall has nothing to do.
The wall's not going to offset that.
The thing to slow down the economy is getting falling asset prices. That's the only way that this works, because the falling asset prices slow the consumer, which hurts the earnings.
But so the Fed tried to do that, and they couldn't.
Well, they did it for 8 months.
Yeah, I mean, they couldn't. I don't think that's right. They certainly could have.
10 months.
They could have portrayed a certain stance and policy yesterday that would have been consistent with, trying to push back against the significant
how about this?
Financial conditions.
The Fed tried to slow the economy, and they really couldn't.
Yeah, I mean it shows that they were not, the tools that they used were not particularly effective, right? We're still at secularly low unemployment and at potential growth, right, or better.
They were able to slow transactions in the housing market. We have the evidence for that. They did that. I don't know if that I don't know what is the transmission mechanism from that into the real economy.
Well, loan officers got laid off.
Yeah, it sucks for realtors.
Yeah, but I mean, even if you look at the real estate sector, like the employment in the real estate sector hasn't really moved all that much. Construction hasn't really moved that. Usually the things that are sensitive to that slowing hasn't really moved that much, partially because we've had the multifamily boom and all that stuff that's been in the cycle that it just takes a long time. And this is the whole thing, is that like our expectations of how these macro cycles, they like whip around. How many times we've been through this? We were, if I came in here last year, it would have been like, aren't we on the face of a depression?
Yes.
And I was like,
this time last year,
like
consensus was recession.
The world is coming to an end,
Yes.
right? And it was like, what has ended up happening is like unemployment today is the same as it was 12 months ago. Like nothing has happened.
What's your biggest takeaway from how crazy the reality turned out to be relative to consensus a year ago? Is the takeaway that people just have no idea what's going to happen no matter what? Or is the takeaway that there's something really extraordinary about the current labor force that made this time truly different from all other times the Fed has been this aggressive?
Well, I think that I'd say there's two things. One, the big picture story of the economy is it all just moves so much slower than like people who are sitting around on Twitter every day.
Yeah.
Right. Every day it's like, we're in a depression, we're in a boom, we're in a depression, we're in a boom.
Right, because they look at the Dow and it's a mood ring.
It's a mood ring. And the expectations are shifting all around, right? We've gone from hikes to cuts to hikes to cuts to hikes over the course of the last year.
Yeah.
So what's happening is the macroeconomy, like no macroeconomist on Twitter is going to tell you this, but it's really boring, right?
Yeah,
like nothing changes in the macroeconomy.
It's a battleship. It turns slowly.
So, I mean, but
it doesn't react to daily data.
So slowly.
That's right.
Years.
So do you think that
and years?
And on Twitter, the narrative changes every 6 hours.
Right. And so the economy is slowing very gradually.
It's almost as if spending a lot of time on Twitter is not a really productive way to get good at investing. I'm just is that possible?
Unless you're reading my stuff.
So you tweeted this. Can we go here, Mike? Do you mind?
Go ahead.
If the Fed is going to more structurally go soft on their inflation mandate, it's a time to sell long bonds, not buy them. The Fed's own dots show no intention to bring core PCE down to at or below 2% until 2026, even under strong economic conditions. Okay.
In English, please. What does that mean?
In English, why does the Fed's current dot plot and their lack of intention to slow their preferred measure of inflation, core PCE, why would that affect the decision to buy or sell long bonds right now for the audience? I already understand all this very well. For the audience.
I'm sure.
And for Michael. Could you explain this to make eye contact with him?
Michael?
Okay.
Let's talk about the dots.
I'm gonna grab a drink of water. You could just explain it to him and then we'll catch him up.
The thing that's interesting about the dots is not what their projections are, because those are actually useless because they have no idea what they're going to do.
That's right.
All can aside, what are the dots?
Oh, the dots. Every quarter, the various Fed governors predict what they think is going to happen to growth and inflation and monetary policy over the next couple of years.
It's literally like a roulette table where they put their chip.
That's right. And it's literally dots on a piece of paper.
Yes.
That's why it's called the dots. The thing is interesting about it is not their predictions, because they have no predictive power. If anything, they're probably
completely wrong.
More likely completely wrong than right. But what you can see is how they are weighing things in terms of where they put their dots. And so as an example, when you look at the dot plot this time, they showed that they think unemployment's going to stay, very low. And they think inflation is going to, remember their mandate, their target is 2% on PC and actually a little bit below that, because they don't want to go meaningfully above 2% in terms of the targeting regime, and PCE is generally a little bit lower overall. So they show on that set of dots that PCE is going to be at, core PCE is at 2.5 and 2.3 and 2.2 out to 2026.
Perfect glide path.
Right? Perfect glide path. But their mandate is 2%.
Yeah.
And so these folks at the Federal Reserve are saying, we are not going to fulfill our mandate. Our mandate is 2%.
But is it 2% right this minute? Or is their mandate to eventually get there?
It's not above 2% for 5 years.
Yeah. 2026. It's almost 2024. They could be at 2%.
No, 5 years from the beginning.
They could be at 2% next month. They can take Fed funds to 10%. They'll be at 2%. I mean, you know what I mean?
Yeah,
but directionally, they like the direction things are heading.
Sure, but the question is, are they meeting their mandate?
Not
the
yet.
answer is like
Not
no.
yet.
And it would be if this was just a wiggle up or a wiggle down, who cares?
Right.
The big issue is whether these inflation expectations get entrenched, and they've been behind the curve for years now. It's not. We're not arguing over 0.3, 0.4, 0.5. We're arguing over, are they comfortable with inflation being above their mandate for 5 years, right? And 5 years is not a wiggle. It's not barely. 5 years is unacceptable.
You might as well not have a mandate.
Right, unacceptable relative to their mandate. And so that's I think there's a genuine question here of like, is the Fed actually not pursuing the 2% mandate? And that would have a lot of meaningful implications, because if you thought that their real view was
3 is okay.
3 is okay,
Right. Hence the Barron's cover this weekend.
right? Then that just changes what you expect the long-term price of money to be.
That's the anchoring part. That's the
That's
part
right.
where people just start getting comfortable with the idea that inflation's going to run faster and hotter just structurally. And then you start seeing that show up in the way people renegotiate contracts and the way people ask for compensation.
Exactly.
So that's problematic if that's taking place already and the Fed has lost control.
Yeah, and I think the issue is that they have control. They could make a decision, and this is why the dots are so interesting, is they could make a decision to have inflation be, more swiftly moving to their mandate. And the way that they make that decision is by, keeping interest rates higher than expected. But when you look at the dots, this is where the monetary policy part intersects with it, is that they're showing that they're going to cut interest rates. So they're going to proactively ease policy during a period when they're comfortable with the fact that they haven't met their inflation mandate and they have no problem with growth.
So what's the implication for long bonds that you're making, that they're more at risk of higher than expected inflation?
Well, if you look at the bond market, basically like everyone has hard-coded 2% as a long-term inflation expectation into the bond market and into yields and things like that. What if it's 3? What if it's not just is it 3, but as you start to ease off the mandate, that 3% mandate, there's more volatility in it. And if there's more volatility, then you need a higher risk premium to hold those bonds. So it's not just 3, it's 3 plus the risk premium, so 325, 350, right? That's the effective compensation you need for inflation, because inflation, if it's at 3, it's going to move to 4 or 5 and then down to 2, et cetera. And so that's the basic question. Like that's a totally different pricing of long-term interest rates. Whereas right now, if you look at long out the curve, it's basically like, people are pricing in 2% inflation forever.
Right.
Till the end of time, right?
So let me ask you this. You mentioned that the economy moves really slowly, really, really slowly. I've been saying that we landed the plane. It's over. Not to say that we can't have a recession, but we did it. The hiking cycle is behind us. We swallowed all of the rate hikes. We did it. Are you saying that we could be easing at the same time, potentially, that we do finally feel the impacts of those 5% interest rates? Like if we get a recession in 2024, do you think it's more likely to be as a result of the lag interest rate impacts, or is it going to be something exogenous? And of course you can't know. I'm just asking.
But
What do you worry more about? Which of those two things?
I mean, I'm much more worried about the plane taking back off,
Okay.
right, than I am about a recession. Where's the recession?
Are you really?
Like, where is the recession? Like, tell me.
So the economy is at greater risk of overheating than of a recession.
Absolutely.
Do you think most people think that right now? Is that where the mentality is now shifting to worry about a lift off of inflation?
No, I mean, I think the Fed in particular and many asset holders are enamored with a soft landing, because soft landing is great for them,
Yeah.
right? And
Who doesn't like that?
but who doesn't like it? But the problem with the soft landing is it's priced in. 170 basis points of cuts is priced in. Stocks are back through the highs.
Okay,
right?
so you think the risk is all of a sudden it becomes apparent that 175 basis points worth of cuts this year
Ain't happening.
is not going to materialize because the data starts to run hot again.
Yeah, and it doesn't. I mean, it doesn't even have to run that hot again, right?
Where would we see it first? like auto prices, like all of a sudden shocking to the upside.
I mean, I think the main
retail
thing,
sales.
you got to look at the consumer, right?
Yeah, I agree.
And when is the-
Airlines. So
it's the
airline tickets
consumer buying.
airlines have come down.
Airline prices have come down.
So
a
I'll give
lot.
you all right. So if I gave you one metric to follow this year to see if the likelihood of that was about to play out, what would be the thing you would follow? Wages.
I mean, I think the wages are the key thing.
Wages
right?
are the key thing.
Wages
So
are
if
the
that
key
starts surprising to the upside 2 months in a row, we got a problem.
I think because that's going to. I mean, if you can only look at one thing, it's like against
I know,
my
but
constitution as a macro guy looking at a whole bunch of things.
I know, but the alternative is here's the toughest part. I don't know anything about macro. Here's the toughest part that from the outside looking in about macro. If you talk to 30 people who claim to either be macro strategists or run money on macro, each of those 30 people follows 30 indicators. They will talk about the one that occurs to them in the moment. If you're on the outside looking in and you don't know anything about this, like me, it's like, well, what really matters? I mean, this guy's got 80 different data points. Well, which one? Like, what really matters? And I'm sure that there is a hierarchy of importance, but the media doesn't know what the hierarchy is.
I think
the media will report on whatever just came out.
I think
as though it's of equal importance.
But at some level, it's relatively straightforward, which is it's inflation and unemployment. And the reason why
the inputs to those things.
So like ISM, is that important? Like what's overrated?
No, ISM is a terrible.
ISM's bullshit. I've always told you this.
ISM is
throw it out. What else?
ISM services.
What else goes in the garbage?
Zero correlated to actual activity.
Throw 5 more things out. We'll never talk about it on the show again.
The S&P 500.
What else?
Garbage.
Yeah. Moving averages, no good.
Who cares about that?
By the way, speaking of the S&P, so we had an incredible run in the stock market. Dan Greenhouse tweeted that the 32-day change was whatever. So I ran it as of the end of the day yesterday. So why 32 days? That's when the October bottom was. So over the last 32 days, the S&P is up 14%, which is over the last decade about as good a 5-week period as we've ever had.
Yeah.
We
saw out of COVID.
We saw that at the bottom of COVID. But considering that we're not coming out of the lows, really, I mean, we were in a 10% correction in October. We had a hell of a run. Holy shit.
Yeah, I mean, I think the thing that's interesting about it is it's all about the bonds, actually, right? So I think the stock investors are staring at stock market. They think, well, everyone thinks these companies are great, but what's actually happening is bonds, long-term bonds, risk-matched bonds, have gone up more than stocks over that time frame.
Depends which stocks.
So it's all, I mean, whatever. The S&P 500.
But so to your point about it's all about
the bonds.
It's all about bonds,
and it's all about. And the reason why bonds are moving is because of the easing.
So
that's the reason why stocks are moving. If you actually look at the Qs, look at the S&P 500. Sean was giving me notes on this before. Over the last month, they're up like 6-7%. It's not that impressive. What's really impressive are the worst sectors of the year. Small cap value, just
Russell's killing it.
Up 20% or something.
Utilities, home builders.
Can we talk regional banks?
Regional banks,
S&P REITs, regional banks, utilities. This is where the sex is happening.
SL Green yesterday sexed 12% higher on the day.
Wow.
Yeah. 12%. Boston properties, like everything that got destroyed because of higher interest rates flew yesterday.
But that makes your point where you say it's all about the bonds.
It's all about the bonds.
None of that would be going on if not for the absolute plunge in rates.
Right. And both directly because of the discounting effect on the stocks, but also because it reflects just a meaningfully easier monetary policy.
Well, also because what was the problem for small cap value? It's a lot of financials and industrials, and frankly, they need to roll debt faster than the S&P does. And so the implication of falling yields and a Fed willing to make the turn is you can now stop pricing in roll risk for these businesses.
That's right.
90% of the S&P 500 debt is long-term fixed. With the Russell 2000, I think it's 50%.
Right.
So much more sensitive to higher rates.
Right. And then those small banks and small financials and stuff like that, they're still holding some long-term debt, right? They're still holding the bonds. Obviously, bonds rallying is a direct benefit. I think the interesting thing there is that KRE is, still well below its.
I think so. I don't like that trade from a secular perspective. I get the cyclical part. They were pricing these things as though they're zeros. They're not zeros if
I mean, you have
if rates are
PEs
going to
at
moderate.
like 5 on
Yes,
some of those stocks,
fine.
right?
So you had that benefit, that snapback. Structurally, it's not going to be fun to be a regional bank going forward. If your primary advantage or edge in that business is your geography, nobody cares anymore. So I'm not jumping in on that trade just because if it goes the wrong way, I don't want to be stuck with those
Yeah,
stocks.
but some of those are, as I say, P's of 5 when you're looking at Bank of America, which is a garbage business, zero growth, wealth management, zero growth loans, right?
Yeah.
It's a 10 P,
Yeah.
right? So, what do you want? You want the, and they've got a much,
Yeah. That's a good
Bank of
point.
America's got a way worse CRE book than, there's, if the problem with the regional banks, you got to roll up your sleeves. You got to get into the nitty gritty of the loan books and the NIMs.
It's
and
not
all
like
that
buying the
stuff.
XLF.
It's not like buying the XLF.
the rally-
I won't derail us to a nitty gritty conversation about regional
But
banks.
the rally also brought it down. Yeah, the Dow hit a new all-time high. RSP, if you look at
Sorry, let me interrupt. This show brought to you by Bank of America. I forgot to mention to you.
if you look,
not a fan. I take it.
if we look just over there, right? We can throw our stones.
if you look at like a ratio of the S&P equal weight to the S&P, like it ripped higher. The rally's broadening out.
Yeah, and I think look when there's a massive easing, which is what we've had. It's a market-based easing, but a massive easing. It should help those. The water's going back out.
Yeah.
Right. The people who got caught are feeling a little bit better now. Right.
Yes.
They're floating a little bit better these days.
Speaking of Bank of America, like one of the big reasons to be bearish as recently as 2 months ago was their mortgage book, and higher for longer would have not been fun. If it's not going to be higher for longer, it makes it a little bit more palatable to be invested in the equity of Bank of America. So, and there's a lot of that, I guess, in many other sectors, not just in the banks.
Yeah, in one form or another, they're exposed to either
Fair.
the financing or the bonds themselves.
Boy, I hope it doesn't reverse. I hope we're not looking at spiking bond yields next week
Hey,
or the week after.
I want to just skip a few topics and say on this bank thing. Bob, you tweeted the great deposit flight risk of 2023 didn't materialize despite high rates. And this is a legitimate concern for some people, at least, earlier in the year. Deposits have been pretty stable, up for months now. And before I hear, quote, but large-time deposits are surging, recognize that the $400 billion increase since SVB is just 2% of the deposit base. So what are this chart that we're looking at and what did not materialize?
Well, this is a chart of the deposits. The blue one is the small bank deposits, and the red line is large bank deposits.
This is wild.
Wait,
and-
why are the large bank deposits falling?
Is that money markets?
Yeah, I mean that's basically people
Oh, shit.
moving money.
That's cash sorting.
Exactly. And the issue is that the large banks, the big banks, they're still offering you zero. So your motivation to move, right,
Is higher.
is higher actually at the large banks than
That's
at the
interesting.
small banks.
Most people would have said it at least 6 months ago. It's the opposite.
Because they would have said the credit risk existed in the small banks, but the small banks have gotten through and their NIMs have been hit a little bit. Their net interest margins.
Why aren't people leaving regional banks?
Why
Because
aren't
there is no risk anymore.
Because there's no risk.
Right. No, but why? How come money's coming out of large banks and going to money market
Because they're
funds and
paying
not-
1 basis
Because
point in
they're paying
interest
nothing.
at the large
and
at the
regional
large
banks are paying more.
And regional banks are two things. One, they're paying a bit more on average, right? But, like the NIM of, Comerica is actually higher than the NIM of Bank of America. So it's not a radically different story. And the other thing is we sort of talk about the benefit of transaction deposits in small and regional banks because most of the banking that's happening there are people who are doing actual business, right? And if you're running a business, you're not carefully managing exactly how much money market flow you have. It's not an investment asset; it's a business asset. If you're building houses in Topeka, right? The money comes in, the money comes out. You're not thinking about it. You're not thinking about the credit risk of your bank, and so it's not that surprising that the capital's all that that it's that sticky.
One of the things that I'm going to be paying close attention to in 2024 are money market funds. $6 trillion now. A lot of that came in over the last couple of years. It was at 4.5 before the recent rate hike, and now it's at 6. So just an incredible run. Balchunas had a stat that we mentioned last week. Something like 20 of the top 23 gathering mutual funds were money market. Like, it's just something crazy. In your opinion, how quickly does the money leave? Because my hypothesis here is that it was relatively slow to go in. I think it's going to be relatively slow to come out. Do you disagree with that?
Yeah, I think because people think of people are often they might shift between one cash-like asset and another cash-like
This is not going
asset.
into the stock market.
But the idea that they're gonna, that someone's looking at that and then boom, flooding cash into the stock market, it's just not how people think about cash and assets pretty differently.
But if the money came out of stocks in the first place, that's different.
But it didn't.
But it didn't. It
It
didn't.
came from checking accounts.
Right. It's mostly people who had their
Does it go back into checking accounts?
Yes. Oh, no.
No.
It's going to stay there.
So it'll stay.
It'll stay.
So there'll be disappointment though when 5 turns into 3 by the end of the year. Let's say 175 basis points in Fed funds rate cuts. Let's say 5% money market turns into 3.25.
It'll stay.
There's going to be some disappointment, but I guess that's not enough disappointment.
I mean,
to
here's
make
the
people-
question: it's like,
Will
take
people
your
even notice?
transactional checking account. Like,
Yeah.
have you carefully figured out how to create, to shift the money into your money market fund and then out, and then how sensitive are you to the rates? And like this is like a classic behavioral.
I'm the wrong person to ask that. I don't even know where my bank is. I have nothing to do with that.
But it's a classic. It's a classic sort of behavioral finance thing. It's like there's a whole bunch of people running around saying, I'm going to, on my Apple app, shift my deposits or whatever. And I think I can get 5% on my Apple app, but then I have to set it up and then link my bank account.
People don't move money.
And I just, what a
Yeah,
pain.
it's annoying.
So here's something that I think we could see on a few TikTok accounts next year when the Fed starts to cut. People will be mad because their easy money is gone when their high yield savings goes from 5 down to 3.25.
Oh, the Fed is stealing my income.
The Fed is stealing my money.
So funny.
So the Fed is going to be easing.
I didn't even think about
people
that.
will think that the free money is gone when it's actually
I
returning.
can't wait for those takes.
That's coming.
The kid on TikTok with like $400 in his account.
It's a
like,
scam.
Where the hell's my
It's a
money?
scam.
The Fed is taking it. Where's my income? Where's my side hustle income? Hey, can I ask you about the stupidest piece of research I've ever seen in my life? You're better off going all in on stocks than bonds. New research finds. That's remarkable. Are they saying stocks produce a higher return than bonds?
Have
Have you heard that anywhere before?
It took 125
Groundbreaking.
pages actually
Is this
to say that.
This is serious?
Did you read it, Bob?
I tried to read all of it.
Who published this research? Hamburger University?
It was brutal.
What is the gist of this? That if you're a long-term investor, you should buy stocks instead of bonds? Is that seriously what they're saying?
That's what they're saying.
But is one more volatile than the other?
That is not something that they would
almost can't
consider.
even. Okay. I almost can't. Okay. I did that research too. That's funny. I reached the same conclusion.
Well, the biggest thing that they say is the key thing to hold stocks for the long term is that when they go down 60%,
Yeah, don't panic.
just don't do anything. It's not that complicated, folks. When your stocks are down 60%, everyone
Maybe even
just
buy more
act
is another thing that you
rationally,
could do.
and it'll be okay. And
Right.
if you're on the verge of retirement, it's going to be okay. You're not. Just don't think about the fact that your retirement savings has evaporated.
Did you and Ben talk about that?
Yeah, it's a joke.
What was Ben's take?
It's just it's nonsense. It's not even worth discussing. It's just,
We should put that research out. Can we talk about ETFs? How's business? Tell us about unlimited funds.
Good.
For the audience that's not familiar, tell us what you guys do.
Yeah, I mean, we've my co-founder Bruce and I have been in the hedge fund business for a long time, and when we left, we thought, I bet we could build technology that can look over the shoulder of those managers and try and figure out what they're doing in real time, and then we could package that into an ETF, make it available for everyone. And that's what we've been doing.
so
for the last
technology.
18
You have Ring cameras in every hedge fund's building.
That's right. Yeah.
What is the
actually,
technology?
I have a keypad logger on every computer.
You're trying to approximate what the return would be for different hedge fund strategies.
Exactly.
And then give it to people in a way that they're not paying 2 and 20. They're
Right.
not locked up. They're not okay.
Right, because we're using technology. We can charge a lot
What's
less.
the easiest hedge fund strategy to replicate? Not easy in the sense that you're guaranteed to make money. I don't want you to answer it that way. Easy in the sense that, hey, it turns out this wasn't that hard of a strategy to reverse engineer.
Equity long short.
Okay, why?
I mean, the reality is, if you're trading equities, there's 1,000 stock pickers out there who will tell you all the nuances of this stock versus that stock. There's only so many types of risk you take. You take countries, geographies, factors,
Size.
sectors, size.
Yeah.
it's like 20 things, and you can boil it down that way. It's pretty straightforward, and you can, put together something that basically does what they're doing at an index level.
But so you can put together something that does what they're doing on the whole.
At the index level, yeah.
Right, because then within that category, I don't know how many hedge funds there are doing equity long short, 1,000?
Yeah, 1,000.
Okay.
Let's say.
So 50 in any given year are really good at it.
Yep.
I'm making that up, but like approximately.
Yep.
So you can't replicate that. You can replicate what the strategy at an index level is returning and how it's behaving.
That's right. That's
Okay.
right. But the thing to keep in mind is that there's no manager outperformance persistence in hedge funds.
Well, we know that, but it's not popular. People don't want to hear that.
They don't want to.
But you can't engineer Lone Pine and give people here now you own a Lone Pine clone.
But why, sometimes it's good, sometimes it's
Well,
bad.
I agree.
Right. And if there's no outperformance persistence, then what you want is that means you can't pick, right?
Yes. Because there's no benefit in picking.
Because there's no benefit in
prospectively.
picking. No prospective benefit in picking. And so you'd much rather get the benefit of diversification in the views than, trying to pick.
Well, if you're a big family office, you probably allocate to 7 or 8 different hedge funds anyway. So you're not picking one in that case.
Yeah.
You might be concentrating.
The reason why we started this, actually, I worked with Future Fund for Australia for a while, which is a big client of Bridgewater's that's publicly known. And what they do in their hedge fund portfolio is they invest in dozens of different funds.
So they're getting the category returns.
And
anyway.
they're essentially getting category returns. But the thing that they do that's so neat is they go to each one of those funds and they say, hey, I got billions of dollars. Like, forget this 2 and 20 stuff. Like, we're bringing the fees way down. So what do? They basically build their own low-cost, diversified index fund
by virtue of their size to their advantage.
That's exactly right.
So why not make it liquid?
Why not make it liquid?
Corey Hofstein tweeted, any hedge fund beta that can be turned into an ETF will be turned into an ETF, at which point institutions have to ask, why am I paying hedge fund fees for this? Why do I want something that's less liquid? I'm betting this trend accelerates. I was about to ask you.
Well, then what do you talk about at parties?
Well, yeah, true. I was about to
your venture investments.
I was about to ask you, who wants hedge fund beta? Because is hedge fund beta something that is actually a good thing? But I guess you're saying, but a lot of these people are already getting the beta because they're diversified across all the 10 funds anyway. Why not cut the cost by 80%?
Exactly. And beta, I think, is not quite right. Like alpha. Like hedge funds generate alpha, right? Returns before the fees.
But is hedge fund beta actually alpha?
Yeah, I call it diversified alpha, right? That's what's happening, right? Is index, it's just a diversified set of alpha strategies, all sorts of different kinds, all sorts of different managers ways.
What's the hardest hedge fund strategy to replicate?
Probably the global macro folks.
Okay, why?
Well, because they're typically
They tweet a lot.
What's that? They
I've
tweet.
noticed.
No, because there's a lot of guessing with hedge fund.
There are a lot of
That's the
different
category of hedge fund manager that is most prone to tweet, right?
Global macro.
Global
guy?
macro.
I don't. I mean, I guess as a global macro guy,
Okay, why is
who's
this
prone to tweet?
Why is it so hard? Why is
Bob
it
feels seen.
Why is it so hard to replicate that particular type of investing?
Well, there's a lot of different assets, right? Because a big global macro fund might invest in 70 different assets, right? And so it's just a more complicated portfolio than you'd see in an equity long short fund, which may look like
the universe is bigger.
Right, the universe is about 4 or 5 times bigger.
When I said guessing, what I really meant was, obviously I was joking, but I feel like global macro is more, there's a lot more art than science. Not to say that there aren't rules-based strategies, but there's so many inputs. How much of that is quantitative that then you have the qualitative filter where the manager will, digest all of the data and then say, okay, here's my interpretation of the data.
Yeah, I mean, I think there's naturally, a range of different managers, but qualitative understanding is certainly a big part of what's going on with a lot of macro managers. Now, what we're trying to do is infer their positions rather than their decision-making rules,
How do you do that?
Which allows us to pick up, if they're using discretionary views. We look at the returns. You look at the returns, at any point in time, and then you know what they trade. You look at the returns, and I'm sure you guys look at this. Like whenever you see a manager, you're like, well, that guy got 5% this month, and stocks did this, and this sector did this. And you sort of say with your gut, like, I think they're probably underweight tech, which is basically all equity long short managers this year. And so all we're doing is we're just doing that process just in a more computationally rigorous way to back out what they're doing. And there's the reasons why. Like as you get to a diversified index, the noise goes down relative to essentially the signal, right? That in terms of the exposures and you can get better understanding by looking at sort of the path of returns.
Okay.
Because these managers, they shift their positions, but it's not instantaneous. So the portfolios that generated the returns last month or 3 months ago are related to the portfolios that they hold today.
So there's no more index funds coming to market. It's enough already, right? We don't need any more. We get it. Balchunas tweeted the percentage of new ETF launches that are actively managed has reached a record 80%, which is wild.
80% of the launches of ETFs were active ETFs.
He said, and he also said,
I'm not surprised by that.
No, active ETFs are also taking a quarter of the flows. I guess are factors considered active? I guess probably for this probably.
Yeah, they are.
But fine. But my point is, it's enough. We don't need any more index funds. We have a million.
We got all the pieces. That's the beautiful thing, right? The pieces are now free. I wouldn't want to be the guy who's creating a business around selling the pieces, right? Because because that's a terrible business. Right?
That's literally commodities.
That's a business that's going to fall to zero, essentially.
Right. Your IP is worth nothing. It's just whose index you can license and what's the lowest amount.
And even these factors, right? These factors are basically free at this point, or so close to free.
Yes.
That it's not worth it. And so the question is, I think a lot of active managers are looking at the ETF wrapper and they're saying, with the regulatory changes in 2021, giving a lot more flexibility to be able to run long, short, et cetera. It's actually a pretty good wrapper to run a product.
Yeah, they're getting permission to not reveal their holdings right away. They're getting like a lot of reasons to, if not build a new one, at least replicate an existing fund in this wrapper.
That's right.
And that directionally probably continues.
I think so. And I mean, the thing that often probably doesn't get talked about is operationally with all these white label providers, it's actually operationally pretty efficient to run an ETF. So whereas, if you go to a big LP fund, like 50, 70% of the people are like people who are doing nothing related to running the money.
Yeah.
Right. So you could be paying 100 basis points of your fund structure for people who are back office and operations. You launch an ETF, use one of these white label platforms, you can do that for 15 basis points.
So this is the last bastion of the mutual fund is retirement. And they just haven't perfected fractional ETF purchasing in 401ks and getting everyone in that ecosystem comfortable with the mechanics of that. 100% it's going to happen. I can't believe it's taken this long. When that does happen and a very mainstream 401k provider just says, okay, this is now part of the mainstream platform. ETF 401k is how we're doing it going forward. That's going to be a dominoes falling moment, I think.
I think it's going to be tough for a lot of those businesses that are running the 401ks because they're charging.
Yeah, they're charging a lot of money for a lot of shit that nobody needs them to do anymore. That's what's held it up. That's what's entrenching the mutual fund structure.
I was looking at target date funds, and if you take Vanguard out, the AUM weighted target date fund cost is like 40 basis points, 50 basis points.
Way too high.
Yeah.
Are you kidding me?
In this day and age, way too high.
Way too high. That's just theft.
Yeah.
Right, for a product that is it's an index product.
Yeah, and essentially the robos are unbundled versions of a life cycle fund.
Right, that's exactly right.
You're putting in the date that you expect to retire.
And they're saying, here's the
they're
mix.
They're giving you the ETF components of what those life cycle funds are buying.
So I think there was a stat about mutual fund outflows from the Morningstar report recently. I think it was 64 straight months or something. So it's a melting ice cube. If that ever happens, it will be a flame, a torch to the ice cube.
Yeah, we just don't know when. If it's gonna, I think it's a when. I don't think it's an if.
But you got a lot of entrenched interest. I mean, like take it from the the David in the ETF and the Active 40 Act product world. Like the Goliaths are out there. They're big and they're angry. right, about this, and they will do whatever it takes.
Well, one thing is though that they are increasingly willing now to dip a toe in both, and like we saw, Dimensional was one of the last holdouts to do ETFs. Now it's their hottest business. They're going to keep going. So at a certain point, there won't be any incumbents left who haven't embraced this for at least their top managers. So like every mutual fund company has its quote unquote flagship,
right?
Or it's like best managers. At some point, the manager is going to say to them, "Dude, I'm crushing it. Why am I in outflow? Why am I in redemption? Like, give me a better structure. All I want to do is manage money. I don't want to watch money leave." Like they're going to have to. It takes so long, like a lot of other things.
Yeah, it takes so long. But I mean, it is true that what huge market size is this? 10 trillion in actively managed mutual funds, right?
Right.
And in actively managed ETFs, it's like 500 billion. And and that includes stuff that I would say is index adjacent.
Right. So
mutual funds are index
but
adjacent.
So you're
too.
part of this new wave of ETFs. Like you came along in the last couple of years, and like investors, advisors, everybody is interested in actively managed ETFs. It took 25 years.
Yeah.
Right? For
It did.
Like honestly, I think say what you want, Kathy Wood kicked the door down. You might not like her investing strategy. You might not love her marketing, but she is the reason that active ETFs have exploded in popularity in the post-pandemic period. And it's staying that way.
She's been absolutely a torchbearer for the active ETF community. I also think from a product creator standpoint, the regulatory changes created a lot more flexibility to do a lot more interesting stuff without having to get approval from the SEC and stuff like that. And, you've basically brought down, I talked to people who started, startup ETF businesses 10 years ago, and it was, millions of dollars to start.
Hard.
Right.
Yeah.
And get the exemption and the legal papers and setting up the trusts and all that stuff. And now today, if you have an idea, I mean, you could literally in 75 days.
I think what's new
is
is
done for a few $100,000.
I was going to say there are platform providers who have figured out it's a pretty good business to help somebody that has a great idea get their product trading. Like
Alpha Architect.
Alpha Architect, Wes Gray. Like those guys helped a few friends of ours.
Yep.
And they realized that, hey, we have a lot of know-how here. We can help these people that have great ideas. It's actually a good business. So that's what's new.
And those guys are I mean, they're great businesses, and they're helping a lot of folks.
Totally agree. Can I play one more thing for everybody?
Is it going to be as boring as that Fed thing?
No, I have much more discerning taste than Michael.
Can we listen to it on 2x speed?
You're by the way, you have tenured professors.
Let me say something. There are about, I guess, 20 million Jews in the world. Think of all the accomplishments of the Jews in science, in the arts. Go right down the list. It's incredible when you think of only 20 million and all they've done and all the truly gifted people.
Thank you.
That may sound like I'm biased, but I am biased because, thank God, most of my doctors are Jewish, and I can tell you right now, they take care of me like a baby, and I'm 88 and I'm still going. So, at least but the point I'm making is, they've done so much for civilization.
Right.
That should be the best.
He doesn't even know
he
doesn't even know the point he's making. I think he wanted to shout out his Jew doctors.
Was that Joe Biden?
That's Ken Langone. That's my guy right now. I was feeling that. He was on Squawk. I guess he probably does it like twice a year or something. He had some stuff to say. But Ken Langone, big fan of the Jews.
Of the Jews. Speaking of the Jews, February 4th.
Don't speak of the Jews.
February 4th, new Curb Your Enthusiasm.
Is it?
All right. Allegedly the last one, but I'll believe that when I see it. I can't wait.
Very cool. I wanted to just throw this out about Netflix for the first time ever. Revealed what people are actually watching.
Did you listen to Sarandos? He was on the town.
Not yet, but there is a lot of information in here.
It's meaty.
What were the biggest takeaways? We've never seen data from Netflix like this.
Not like this.
What were your biggest takeaways?
So Ben Thompson wrote about this, and this is not at all surprising, but the power law structure that exists in Netflix, that exists everywhere else in the world. If you just plot this out, hours viewed, it looks there's nothing and then there's everything at the top. That was takeaway number one.
How did the night agent get to be the top?
There's a lot of garbage.
It was just okay.
It was It was like something that you have on in the background
Can
when
I
you're
give you my
answering a
theory?
few emails.
But that's
at
what
9
it
o'clock
is.
give you
at
my
night.
That's
theory,
what it is. Nobody
right?
watches it. It's in the background.
Certain
Right.
things come along at a time when they're not competing with a lot of other things, and it benefits them. But I also think Netflix has the power to make something a top 10 hit.
Yeah,
At
well,
least
that
for
was
the first
that was
week.
my guess. My guess is it just just came on.
Well,
you
if they
know?
spend if they spend enough money on something where they decide we're going to get behind it, I
Right.
watched them do this with like they decided that 1 week Bird Box was going to be the thing, and they manifested that by virtue of where they placed it on everyone's screen. It's objectively terrible. It's Sandra Bullock with a scarf around
And it
her
was
eyes.
a cultural phenomenon, and it was awful.
It was awful.
It was awful.
But they have that power, maybe not forever, but right now, that's different. There's no cable system that has ever been able to do that for programming.
That's right. That's
So
right.
that's what was really fascinating to me. I don't know. Anything else on
30, I
this?
think 30% of the list was outside of was non-English. It's just a lot of garbage. I mean, I'm a happy Netflix shareholder, but there was just a lot of junk on this list.
I can't believe twice as many people watching Emily in Paris as Squid Games.
You're surprised? I'm not.
My wife just
I mean,
watched.
you've got
It's
to
more.
be kidding
It's
me.
more accessible though for most
You've
people.
got to be kidding.
My
me.
wife just watched Squid Game. It looks like the challenge.
The challenge, yeah.
That's what it
Oh,
looks
it's
like.
great.
I don't watch the challenge, but
What is it? It's like a reality show.
Yeah, I mean, it's like
game
a
show.
it's take the Squid Games. They don't murder the people, but
Oh,
they.
so then that's a.
It's a little lower stakes, but you get 80% of the fun.
my favorite recurring show on Netflix. My wife watches it mostly, but I pop in. Love is Blind. Great. It's great.
What is that
TV.
about?
Love is Blind. It's a great premise. It's basically blind dating. It's
It's a game show.
Two people. It's two people who are in a room together and they're separated by a wall, so they can't see each other. And they date and they propose to each other in all in like a week period.
It's a reminiscent of Dating in the Dark, which I'm sure you saw back in the day.
That's my people before my time, but it's a wonderful train wreck. I love it. I love it.
All right. Did you have fun on the show today?
It was awesome.
Did we make all of your podcasting dreams come true for Christmas?
Of course.
Are you doing a lot of podcasts these days?
Yeah.
Are you out? You're out and about right now.
Out and about,
I love seeing everywhere I see you. I turn the volume up. I always learn from
Nice.
you. What's your favorite podcast in finance right now?
Compound and Friends.
Look how smart this guy is. So quick too. All right, we're gonna do favorites, and then we're gonna let everybody get out of here. You've been on the show before. I see you brought us something. What's your favorite of the week? What should people know about?
Oh, Hidden Forces.
Okay.
Which is not
I know this
a
dude.
finance podcast.
Dimitri Kofinas. Yeah, I know.
Very interesting. I listen to, I do enough of this on
Yeah.
my day-to-day, like sort of, podcasts that explore a lot of different stuff. This one was about UFOs. I'm like a space. I'm space interested.
You're curious.
I'm space curious.
Are you UFO curious or just space
Yeah,
curious?
space and UFO curious. And this was like a smart, thoughtful person basically asking, the questions that would come to your mind to someone who spent a long time, actually an academic who came out of religious studies and actually came to it based upon seeing similar recounting of experiences, let's say, in the religious history, in religious documents back thousands of years.
Duncan was once abducted by aliens.
And then, now is studying it today. It was very interesting.
Did you ever read Where Is Everyone?
No.
You would like this book. You're familiar with Fermi's paradox?
Yeah.
Okay. So the book gives maybe 24 different chapters, 24 different answers to Fermi's paradox, which is, I guess, what's the easiest way to frame it? If the universe is this big, like, where is everyone? Why haven't we? And these theories range from, they're here, we just don't know,
right,
to actually we're an intergalactic zoo and we're being studied and or petted. I thought it was a really interesting way to answer that question with like 20 different answers of like what
That's
could
cool.
be plausible answers.
Have you
You'd
guys
be into that book.
Have you guys seen A Fire in the Sky? Movie from
movie?
the 90s?
Yeah.
That scared the shit out of me as a child.
Why?
Because this guy got abducted and it was like real.
probing.
It was real.
Not
The
into probing?
There was probing.
There was probably. Did you read the Jamie Dimon article at New York Magazine?
I did.
You read it?
The whole
Do you know
thing.
what we're referring to?
No.
Okay. There's a guy, his name is Gary Cernovitz, and he's
Does he work
not
at
a
a hedge fund? What does he work?
he's not a writer. He's like a hedge fund guy, but he wrote this, and he's a client of JP Morgan's. So, like, with a little trepidation, he's like, should I even be writing this? Like, I do business with them, but it's not mean-spirited at all. it's Lime Rock Partners is the name of his firm. And I was chatting. I was not to brag. I was chatting with him a little bit on LinkedIn. But the gist of the article is this is now a $4 trillion bank. It is pulled away from Bank of America and anyone else that was considered its peer. It's like a one-of-a-kind operation at this point. What makes it tick? Like, what is Jamie Dimon really doing?
Fraud.
Yeah. I thought it was a really well-done article, and it was published in an interesting place, New York Magazine. You wouldn't expect to read such a deep dive. It's like thousands of words. You would appreciate this as well. So the article is called Jamie Dimon's $4 Trillion Machine by Gary Cernovitz, and that's at New York Mag. Michael, you got something for us?
Last night I was watching Headliners
Probed.
Stop it. Headliners Only. Kevin Hart and Chris Rock go on tour. And it's the history of their friendship and coming up through the ranks. And it's if you're a fan of comedy,
I didn't even know that existed.
Gotta watch. I think it just came out.
Where is it?
Where do you think?
Netflix?
Netflix.
They're the best.
Yeah.
All right.
Right under The Night Agent.
There.
We'll check that out. All right. Hey, everybody. If you enjoyed... Hey, everybody. If you enjoyed learning from Bob...
Duncan's got something.
Oh, you have some for us?
Yeah. With
I was about to wrap up. Go ahead.
Spotify Wrapped, I just wanted to share a couple of things. So we've had people sharing that we're in their top podcast, so please keep doing that. If you're listening on Spotify, share that with us. We love seeing it. Trying to find the person who's listened the most. So if you think you might be that person, share that. We got David Walsh with us in #1 spot. We've got Bernard with us in their top spot. We've got Adam in the top spot.
There we go, Bernard.
And we've got,
love you guys.
interestingly, Paolo from Poland. I can't read it, but it says 4,921 minutes of listening. They're in the top 2%.
Thank you.
Pretty cool.
Thank you.
Cool.
That's awesome.
Love that. Thank you guys for listening to us on Spotify. We appreciate it. Hey, everybody. If you enjoyed learning from Bob as we did, here's how you can follow him. Your Twitter account is at Bob E Unlimited, the E for Elliott.
You got it.
At Bob E Unlimited. And you're pretty active. You put out charts and stuff. Okay.
Two times a day.
All right. And on LinkedIn, what are you doing on LinkedIn? Like roughly the same
thing. More
I
industry
find myself
commentary.
like doing almost the same thing I used to do on Twitter on LinkedIn.
Because Twitter's more macro stuff.
Okay.
LinkedIn's more industry commentary.
Oh, that's interesting that
Stuff
you
like
break it
that.
up that way.
Yeah, I break it up that way. Get people are more interested when they go to LinkedIn about the industry and
Well, because they're there as their professional self, not
Exactly.
as like a trader per se.
That's right. So I got to you keep people interested. And I also have a YouTube.
Tell us about the YouTube
But,
channel.
I mean, I don't. You guys are masters of this stuff. We just tried to throw some videos up, see whether it's.
How do people find the YouTube channel?
I don't know, Bob Elliott.
I don't know,
YouTube.
All right.
There's some SEO on it that I haven't figured out. I'll get
All
some
right.
tips from you guys.
We'll find it. We'll link to it. We'll excerpt it. We'll play audio from it. We'll do all the things. All right. Bob Elliott, ladies and gentlemen, thank you so much for coming. We really appreciate it. We had
Thank you.
a great
This
time
was great.
talking to you. Awesome, man. So this is the intermission. We're gonna have you stick around. We're gonna do another hour when we get back.
Awesome.
Sounds good.
Keep doing it.
All right.
We
Compound
can
and
go through
Friends
the
is
other
out.
indicators.
Ratings, reviews, do the things. We'll see you next week.